Imagine logging into your investment account, hitting withdraw, and getting a message that your money is locked inside. This is the reality right now at some of Wall Street's most prestigious institutions, including Blackstone and Morgan Stanley. They are restricting investor access to a massive $2 trillion market known as private credit. Everyday investors put their cash into these funds, expecting liquidity. Instead, they are hitting gates, hard limits imposed by the funds on how much money can actually leave in a given quarter. These redemption gates are the first visible signs of structural failure, indicating that the internal reserves meant to satisfy investors have finally run dry. Private credit flows from investors into a fund manager's pool, then to businesses and software companies denied bank loans. The fund promises regular cash access, yet that money is locked in 5 to 7-year corporate loans. This creates a liquidity mismatch. As long as the economy is stable, the setup holds. New investment money constantly flows in, and fund managers use that fresh cash to pay off the few investors who want to cash out. But in the spring of 2026, two massive external shocks hit the global economy at once, freezing that incoming flow of cash. The entire $2 trillion private credit market relies on the mathematical assumption that everyone won't ask for their money back at the same time. Now that assumption is being tested. Look at the satellite view of the Strait of Hormuz. The US-Iran conflict has blockaded this narrow waterway. Because 20% of global oil travels through this corridor, severed pipelines cause crude prices to shoot past $110 a barrel. Expensive oil forces domestic inflation back up, which paralyzes the Federal Reserve. They cannot deliver the interest rate cuts that the market had priced in. Those high interest rates feed directly back into the private credit market. The mid-sized software companies holding those 5 to 7-year loans are suddenly crushed by borrowing costs they never budgeted for, triggering a wave of defaults. A naval blockade halfway across the planet ensures that a software company in California can't pay its debts. That is the direct mathematical reason Wall Street funds are barricading their doors. As companies drown in high interest rates, they turn to aggressive cost-cutting to survive. They are specifically targeting their most expensive asset, white-collar labor. The trend is accelerating across the tech sector. For example, the payment company Block, led by Jack Dorsey, announced they were replacing 40% of their workforce with artificial intelligence tools. These layoffs hit highly paid professionals classified by banks as prime borrowers. These are the individuals whose stable incomes anchor the consumer economy. Losing these high-salaried professionals strikes the foundation of the U.S. debt system. When prime borrowers can no longer cover their high-leverage lifestyles, defaults begin spreading through the $1.66 trillion auto market and the $13 trillion residential mortgage market. AI is acting as a rapid accelerant, vaporizing the reliable, high-income cash flow that the entire U.S. credit system relies upon. Why should the average person care if a few elite hedge funds lose money on private loans? Take a look at this data bridge. There is currently $1.9 trillion in direct loans connecting traditional regulated banks to these unregulated shadow private credit funds. As the private funds' underlying assets lose value, the traditional banks demand more collateral. To get that cash, the funds are forced into fire sales, dumping assets at a massive loss, which only drives their valuations even lower. That $1.9 trillion bridge is the transmission mechanism. It takes an isolated problem at a private hedge fund and pipes it directly into the checking accounts of the real economy, recreating the same contagion risks we saw during the Lehman Brothers collapse. The severity of this fallout depends entirely on a ticking clock tied to the duration of the Middle East conflict. Financial models show the probability of a systemic meltdown sitting around 10% in March. But if the oil blockade drags into June, the likelihood of a total system freeze jumps to over 50%. If that happens, we face a scenario known as stagflation. As this photo from the 1970s oil shock reminds us, stagflation is an economic condition where growth grinds to a halt and unemployment spikes, yet the prices of everyday goods continue to soar. Time is the enemy. With every day that the shipping lanes remain closed, the illusion of liquidity holding Wall Street together comes closer to shattering. In this environment, the traditional retirement portfolio, split 60% in stocks and 40% in bonds, offers almost no protection. A simultaneous spike in inflation and a freeze in credit cause both stocks and bonds to drop together. Hedge funds are adopting the extreme barbell strategy to survive the storm, dividing their capital into two radical extremes. On the defensive side, cash, short-term bonds, and physical gold. On the offensive side, pure artificial intelligence infrastructure and data centers. The logic is efficient. Extreme defense guarantees liquid cash when the rest of the market freezes. The extreme offense captures the only sector where corporations are virtually guaranteed to keep spending money. Modern finance is a deeply interconnected web. A burning oil tanker in the Middle East and a tech CEO's artificial intelligence strategy now dictate the survival of global retirement accounts.